This is Macro Voices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. Macro Voices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Josh on the show. It's always great to have some rational kind of a perspective on gold and just what are some of the real drivers behind gold prices and how to model it all.
Patrick, I couldn't agree more. Josh is a super guy. And again, folks, we're going to be bringing you more and more precious metals content on Macro Voices in coming weeks. Let's move on now to our postgame chart book. Listeners, you'll find the download link in your Research Roundup email. It says Big Picture Trading Chart Book. Patrick, as we dive in here on page 2, you're showing the S&P chart and basically the big sell-off that we had, 36% in 32 days. You had projected that maybe we would see a bear market rally up to a 50% Fibonacci retrace, which would be around 2,800. Now, I noticed that it looks like it's starting to roll over, and we got almost exactly to a 38.2% Fib retrace. Do you think that was it, or do you think we're still headed up to 2,800 before the bear market rally is over?
Right. So the key to this chart is I'm not actually forecasting that will play out this way. What my goal here is simply by me overlaying that. It'll be fun for us in the coming post games to just kind of see how much the analog plays out to how the price action develops. It's never going to be the same, nor is it a forecast, but it's just going to be interesting. And the point really behind it is that it is very likely that the bear market is not over. And it's interesting. There's no shortage of very well-known people out there that are in that same camp. We should have David Rosenberg come back onto the show in the coming weeks or something because he's also in that camp. And really what it is that when you have such an overextended market, you're going to have a retrace. It's going to be a bounce. It's just so oversold that the market naturally backfills the move. And really at this stage, it's will we see 2,800? I still think that there's room for us to have one more surge in the coming week or two that could potentially go as high as 2,800. But really, I'm not going to deviate from your view, which is that there's another leg in this bear market coming very likely in the coming weeks.
Well, something that occurs to me, Patrick, after watching today's action in crude oil is, maybe part of President Trump's motive, maybe he's actually not so crazy as to believe the nonsense that he tweeted. Maybe it was a little bit of a intentional flub where he knew that tweet was going to pump the oil market. We're coming into what everybody knows is kind of going to be the hardest 2 or 3 weeks of the COVID-19 crisis. Maybe what the president's trying to do is pump markets up so that they've got further to fall as we get through the worst of the crisis, and maybe that's what he tried to do with the oil market today. Now, if that is his motive, presumably he might be trying to do something to get the stock market up another leg too. So maybe that 2,800 will still happen.
Right. And so let's move on to chart 3, page 3, where we have the crude oil chart. And, this is where I want you to do a little bit of talking in terms of explaining how this also works from you, because you're the one that trades oil markets far more than I do. But when a lot of retail investors and listeners engage a crude oil chart or look at that chart, they often associate it with a stock chart, something like Apple or an index like a SPY, and then they assume that wherever the price is and you buy it, then you have all the upside from there. And they don't understand the dynamic of how futures markets have monthly expiries. And these charts are often showing just the spot price, which is the front month oil contracts. And the contangos in the curve, which we'll talk about in the upcoming charts, actually influence whether or not you make money. Like you basically would need a very big percentage move in a very short period of time on that front month contract in order for that chart to show that gain there. And so we have on here showing that May, June, July, August, and September oil contracts. You can see it goes $24.50 to $27.50 to $29.50 to $30.50 to $31.50 on those oil contracts, and each one of them are moving at different rates of change. Like for instance, when we see Donald Trump sending out that tweet, the front month spot oil is actually popped 4.25 on this chart, but yet the September contract's up barely $2, right? So what is it that our listeners need to understand about this, and how do you always approach it?
Yeah, we've gotten a huge number of inquiries, whether it be emails or Twitter or what have you, with people saying, okay, $20, this has got to be an incredible buying opportunity. Okay, maybe it's going to go down to 15, maybe it's going to go down to 10, but I don't care. I can afford to buy it for 20. I know it's going back to 40 in the next couple of years. I know I'm going to double my money. Well, the thing is, you don't double your money in commodity markets. If you buy at 20 and the price goes to 40, it doesn't mean you made $20, even though it kind of feels like you should have. On page 3, you see that the May, June, July, August, and September contracts are quoted. And the last trade price is showing you that, each of these different 1-month contracts has a different price. It's a lot easier to see this if we move on first to slide 4. This shows you what the term structure usually looks like. So the leftmost yellow dot there at the very top of the chart, that would be the current expiring futures contract, what we call the front month. Then the next dot next to it is the next month after that, and the next month, and so forth. Once you get 2 or 3 months into it, generally speaking, the prices get lower and lower. There's a discount as you go further out in the curve. That condition is called backwardation, and it tends to be the most common shape of the crude oil futures market. What we have when the market sells off dramatically is a situation called contango or super contango, which is just a very exaggerated contango. Moving on to slide number 5. That's the same curve, but you see what's happened is the front month has sold all the way off to $20. The very next month is like $4 higher, and the next month after that is another $3 higher. What that means is that if you buy that thing for $20, at the end of the month, you're going to have to roll it forward, and you end up giving up $3 or $4 of price. So now you've rolled into the new contract. The price went from $20 to $24, but you didn't make anything on that. You're flat. And then a month later, it goes from $24 to $27. You still didn't make anything because each time that you roll forward, you're losing that contango between the first and second month. Now, a lot of people have said, wait a minute, that might be true in the futures market, but if I'm buying through an ETF, what does it matter? I've just, there's only one price for the ETF.
So, Eric, when I look at this deep contango curve that we see on the oil structure, it reminds me a lot of, obviously, the VIX futures, the volatility, and always trading contango that have the negative carry as the somebody who is long volatility has to continuously be rolling and is being essentially taxed for being long volatility. So a lot of people ask that question, well, I'm just going to avoid having to deal with futures and I'll just buy the oil ETF. And that's where a lot of people don't get that those oil ETFs are rolling those futures inside those ETFs, right? And so what we have on page 6 is I overlaid the crude oil chart, which is the candles, and then we overlaid 2 ETFs, which one is the USO, which is the unleveraged United States oil fund, and then the leveraged ProShares Ultra Crude Oil contract. And the point of looking at this chart in 2019 is it's showing the tracking during a period when there's backwardation. That's why we had that November 2019 chart that we were showing, is it was showing that in backwardation, in fact, they can pretty well track oil in half decently throughout this period, right? What we find, though, is that, and like you were referencing earlier, Eric, is that on page 7, when we go back to when in 2016, when we saw that huge contango in oil as crude oil crashed down to $26 a barrel back then, as soon as that contango appeared in the curve, all of these ETFs materially underperformed the actual price of crude oil because they are rolling those futures in there, right?
Exactly. And, if all of this business about rolling contracts is confusing anybody, a simpler way to think about it is this. in order for you to buy oil, you got to have a tank to store the oil in. And the cost of that storage is reflected by the contango in the market, the difference between one price and the next. Somebody has to pay that storage fee. And when we get to a crisis like this, the storage is at a super high premium in price, and it's the storage cost that's killing you. Now, if you buy the ETF does all of the fancy footwork of the trading, but they still suffer those same losses. The point is, you can't buy $20 oil now and wait till the oil price is $40 and have doubled your money. It's actually possible to wait till the oil price is doubled and to have lost money. Now, that's probably an extreme case, but it has really tricked a lot of people. They thought they were going to double or triple their money. The oil price doubled or tripled, but they only made 15 or 20%. It's called tracking error, and it's inherent to any ETF that tracks the price of a physical commodity, and it's particularly pronounced in a situation like this where crude oil is reached a super contango condition. And finally, moving on to slide 8, folks, don't forget you can get a free trial of Big Picture Trading. Just go to bigpicturetrading.com and sign up for your free trial.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.